There's this appeal of being able to speak to like an individual investment versus just being invested in a fund. Like one is sexier and has more appeal, right? Like as an investor, you're probably more excited about being able to talk about a specific company you're invested in versus like a fund that you're invested in, right? And so that sort of like shiny object syndrome is, it just like don't fall for it.
Hi, this is Matt Palker with Wendy Lee. We're co-founders at Ivy Invest, and welcome to this week's episode of The Investment Office. As always, we're here to discuss the latest in institutional investing, private markets, and alternative assets. This week, I wanted to talk about a topic which a lot of my friends and family ask me from time to time, which is, should I be investing in this opportunity, this deal, this company, and how should I evaluate it? And of course, my answer to them often is, you probably shouldn't be picking individual companies. But it is a topic that we hear a lot, and so thought it was worth exploring. Wendy, I would love to hear your initial thoughts on this topic.
So it's funny because I think this is something that as institutional investors, endowments, foundations, it's so not how endowments foundations typically think about investing, cherry picking individual companies to invest in outside of co-investing alongside GPs in which these institutional investors may already be invested in their funds, right? I think we've talked a little bit about how LPs, institutional LPs co-invest alongside GPs and how that creates a different kind of alignment. But the idea of cherry picking and evaluating standalone individual investments, for most institutional investors, it is just so outside of how they would think about constructing a portfolio that it's funny that it is, to your point, so oftentimes where individual investors might be thinking about entering private markets and alternative markets, right? It's like just a polar opposite perspective where for institutions, the default is, of course, you would think to find an investment manager with expertise and deep subject matter expertise in sourcing a network and the ability to execute on that specific type of strategy in which this investment might fall under, versus for individual investors, I think there's this, I don't know if it is just because individual investors are so much more familiar with stock market investing where it has become increasingly easy to pick single name stocks to invest into in your portfolio. And I won't comment on whether that's the right way to build a stock market portfolio either, but I think it is something that is so much more familiar given the public market experience for individual investors that perhaps that's why individual investors think about entering private markets in the same way. It's such a different ballgame, right? It's
right.
such a wholly different ballgame.
Right. I was gonna bring it back to as you said, there are certainly folks who invest into individual public companies, and not something I've ever felt comfortable doing. I have a number of friends who do it professionally, right? Like they are professional public stock pickers working at large hedge funds, for example, and I see the level of work that they put in to making those individual picks and the level of research, because it's their day job. I mean, they're spending 40, 50, 60 hours a week. And so my perspective on individual stocks as well, I'm certainly not putting in that level of, I don't have that kind of time to go pick individual stocks. And so, but that's one thing to your point, because at least for an individual investor, they have access to most of the information, certainly, that an institutional public equities investor does. But on the private market side, to your point, the level of information that an individual investor would have access to is pretty minimal.
Yes, exactly. And I think that's so true in private markets in general, is that there is just a lot less transparency. There is no such thing as fairness in distributing information, this material non-public information threshold that you can't breach in public markets. Like they're private markets. It is perfectly okay for certain investors to have material information that others don't have, right? And so I think this lack of transparency and information asymmetry that tends to be far more prevalent in private markets is perhaps not as well appreciated as perhaps it should be. And when we talk about private markets, certainly we're talking about individuals investing perhaps in individual companies, if they're shown a deal for a company, or if they are shown deals for individual securities, whether it's, I think there are certain platforms that allow individuals to invest into single name credits or loans or real estate, individual properties, right? So there's just a lot of, across private markets, across these different types of investments, there's a lot of information asymmetry. And I
Well,
think
and
that's
what you mentioned something which I think I've said this before on a prior episode. This question that I always ask myself is like, why am I being shown this deal? Right, understanding that for most companies, I think there are advantages to raising capital from institutional investors in terms of the scale of capital that you can raise from a single investor, in terms of the sophistication of that investor to be able to understand your business. And I think the default for most companies, depending on the stage, is to go raise capital from a sophisticated institutional investor. And so if there is essentially allocation left over that I'm seeing as an individual investor, my natural question is, why am I seeing this? And maybe that's not always the right way to think about it, but I think generally it's served me well. And I do think it's the natural question that any individual investor should be asking, both in the sense of, is this a good company, but also especially like, am I paying a reasonable price? Because I think that's a challenge in so many of these markets, is how do you judge valuation?
I think that's totally fair. It's totally fair. And I think it's one of those where the ways in which individuals are being shown these investments is changing. I hear a lot about investment clubs, and I hear a lot about smaller groups that are coming together and trying to encourage folks who haven't previously been investing into these types of markets and to these types of investments, trying to bring folks in. And it does go to this democratization theme, which, again, I think you and I can broadly agree, we're big fans of increasing access to investments more broadly, whether that's public markets, private markets. And so overall, I think the idea behind it is terrific. I think it is just really challenging for individuals to get into a flow and a deal flow where, if it is not their natural state of being, and what I mean by that is, let's say you are a family office that has made your wealth through real estate investments, and so you've got now a family office that you're investing out of, and that wealth creation for the family really came from real estate. Well, they're probably going to be far more equipped to consider individual real estate properties and co-investing alongside friends or colleagues that are showing them individual deal flow. And I know I described a real outlier investor here, talking about not just even someone who's ultra high net worth, but a family office that has created wealth in real estate as having subject matter expertise to be able to pick individual investments. When you think about individual investors who maybe are being brought into, again, one of these investment clubs, or maybe joining an investment platform where there's individual, whether it's stakes in companies or individual, the ability for individuals to invest in single loans or single assets, I think it becomes a lot more important for the individual to ask exactly what you just said. Why am I seeing this deal? Why is this deal on this platform or being shown to this investment club? What is the underwriting that has gone into presenting this investment before the group? Even something as simple as, what is the way in which this investment club or platform sustains its business model, right? Is it a group of sophisticated investors who are looking for additional capital to invest in the deals that they themselves have expertise in, right? There are some investment clubs, and they tend to be much more closed off, where that might be the case. Or is it, I think, as is more commonly the case for the ones that are reaching the biggest audiences and making themselves the most openly available, is the case that the platform itself is the business model simply aggregating assets and taking a percentage of those assets to funnel into individual deals. And so it becomes, what's the alignment, right? And I think as an individual investor, the temptation to be able to feel close to an investment is I think understandable, and it might feel a little more daunting to, say, put your trust into an investment manager that then is selecting those individual investments, and that feels more arm's length. There's this appeal of being able to speak to like an individual investment versus like just being invested in a fund. Like, one is sexier and has more appeal, right? Like, as an investor, you're probably more excited about being able to talk about a specific company you're invested in versus like a fund that you're invested in, right? And so that sort of like shiny object syndrome is it just like don't fall for it.
I think that's real, right? I think that part of, for a lot of folks, the appeal of private markets is that it's the other side of the coin of access being difficult. Access being difficult is bad because it restricts most investors from getting a look at interesting things. But the flip of it is, if you do get a look at something, you can feel like you have an opportunity to outperform because you have this unique access. And it probably sometimes can make for good cocktail party discussions as well. But I think one thing that's really also interesting here is just a question of portfolio theory, right? Which is, and I'll speak to the one asset class that I know reasonably well, which is venture. A single venture fund with, call it, less than 15 or 20 positions, I think would generally be seen as perhaps running the risk of being overconcentrated. And I have less context for how that might look in the case of a real estate fund or what have you, but I suspect that and you can tell me that's true in general. And so then the question becomes, just again, think about venture. How much capital would somebody need to go accumulate a portfolio over the course of 2 to 3 years, which is the lifespan of a typical investment period for a venture fund? Let's say 15 companies. It's not an insignificant amount of capital. And so then the question becomes, well, if you are picking individual deals, do you have enough of a portfolio, given all the benefits, obviously, of having diversification in a portfolio?
Mm-hmm. Yeah. And it is, I think, more specific to venture, whether, that concentration risk is higher in venture. Like, the risk of being concentrated is higher in venture because, again, the outcomes tend to be more skewed. But certainly in other asset classes, it would, a 15 holding portfolio for, let's call it, a leveraged buyout fund, or a 15 holding portfolio for, let's call it, a real estate fund, would not necessarily be overly concentrated per se, but it would, I think, for an individual investor, it would require still a lot of capital to even get to that point, right? And then certainly to participate in some of those private deals probably requires a lot more capital than participating in a smaller check in, let's call it, a startup or a venture type deal, because I guess that's sort of some of the appeal of why maybe investing to private companies in their earlier stages has become more readily available to a broader base of investors, and that threshold has been lowered, is because a lot of times the individual checks that folks are willing to collect are lower. Really, truly not the reason to do something just because it's available. But I think that's sort of the whole point of this conversation right now. It's a real balance between being interested in and investing into alternatives and finding an opportunity in which to invest, and then thinking about, that allure of investing into something that maybe makes for, to your point, interesting cocktail chatter, versus on the flip side of it, putting your investor hat on and thinking about this as part of an overall portfolio. And does it make more sense to invest through a fund manager, which, again, going back to the largest multi-billion-dollar institutions are choosing to invest through fund managers, are not making individual company bets on whether it's the leverage buyout side or the venture side, the early stage venture side, outside of, like I said, those co-investments. And so as an individual investor, I think even more so, just the maybe shifting some of that mindset that folks might default into, which is actually it's much, I think, more approachable to invest through a fund manager in the private markets, where that fund manager likely has more information because of their specific expertise in that particular part of the market, or a lot more experience or depth of network, and again, their sourcing and their pipeline are going to potentially be far less exposed to negative selection bias than what might appear on a broader platform or investment club that's being shown to a lot of individual investors.
Right. And to some extent, going back to something you just mentioned, the regulatory frameworks here probably carry some blame, because counterintuitively, it has actually now become easier for an individual investor to get access and invest in individual companies than it is for a non ultra high net worth individual to invest in funds. So kind of concretely, right, there are now a number of frameworks, the Reg A, Reg CF, that allow for companies, private companies, to go out and raise capital from individual investors who, for example, are not accredited, and to raise small dollar amounts and raise, from many, many investors. Whereas on the fund side, first of all, if you're a private fund, there's essentially no ability to raise money from a not accredited investor. That basically doesn't really exist in any kind of scalable way. And then if you want to take in accredited investors, so people who are certainly wealthy but not necessarily ultra wealthy, the regulations cap how many total investors you can end up having in your fund. And so, to the extent that you are a fund that wants to raise more than $10, $20 million, it just becomes prohibitive. And so you're forced then to only raise from what are known as qualified purchasers, which is a much higher bar. You need typically $5 million of investable assets as an individual in order to get access to those private funds. And so I think it's really unfortunate that in some ways the regulatory environment or the regulatory kind of frameworks have perhaps pushed individuals into what may actually be more risky investments from a portfolio standpoint than if the frameworks were instead designed to make it easier for folks to invest into professional managers.
That's such a good point that you make there, and it is really unfortunate that some of the regulatory rules and policies that have been created to protect investors have, to your point, counterintuitively made it such that investors can be investing into things that are actually much higher risk, and it creates this sort of weird conundrum for individual investors. And it's interesting because I think today, more than ever, it's probably even harder to be investing in individual companies where, again, folks might be going onto a platform and having the opportunity, to your point, to put a smaller dollar amount into companies that are raising capital. And
yeah, certainly a lot has obviously been written and said about the kind of level of disruption that AI is going to create broadly across the market, but I think it's exacerbated here, right? In terms of how do you imagine picking winners when the dynamics of company building and operating a company are shifting so massively. And I think that's going to be true at the early stages, but frankly, it's also going to be true and maybe even more true at much later stage companies as you think about, companies that are services heavy or, where customer service is a big part of the product, and how is that going to be disrupted and what does that mean? And, one of the seminal books in Silicon Valley world is this book called The Innovator's Dilemma. And it's this whole idea of disruption and the idea that new companies are able to take advantage of market shifts to displace incumbents. Mm-hmm. And it certainly remains relevant today, but it's interesting because the core idea of the innovator's dilemma is that often you can come in as a new entrant and compete on a different set of product functionality. And one of the examples in this book is the early days of hard drives and how new players were able to come in and offer smaller hard drives, and the performance of these hard drives, the storage of these hard drives was actually less compelling. The price per megabyte was not as good as the larger hard drives that existed, but they were a better fit for the smaller computers that were now coming to market. And so they were able to compete on this very different axis, which was just size of hard drive. And that over time, the other metrics on those smaller drives improved and the new players displaced the old ones. And I think that continues to be true. But I think what we're seeing here, and the risk here is a somewhat different dynamic, which is not necessarily about product functionality, but it's actually about the cost to operate a company. In that what you're able to do now is you're able to produce an equivalent product, let's say, with far fewer resources and far fewer people and in less time. And it's going to mean that companies that are kind of AI first or AI native, however you want to say it, are going to have very different cost structures than companies that are not. And I think that this is kind of a new dilemma, because if you're an incumbent, even if you're aware of this dynamic and you're looking to go implement AI and get faster, the truth is you have a huge workforce that you may not need anymore. And it's very hard to go fire 50% of your people. Elon Musk can do it when he buys Twitter, but most executives are, for better or worse, just not willing to actually go do that. And because, I mean, part of it's just human. Nobody likes firing anybody. But if you're a company that, you have 100 engineers on your team building product, and all of a sudden now a new company can come in and build just an equivalent product. Let's not even say a better product, an equivalent product with 10 or 20 engineers. That's a cost structure that's going to be almost impossible to compete with. And so I think that's going to create this really interesting risk and ultimately disruption.
Mm-hmm. And it's interesting because for us, this is not necessarily a hypothetical discussion, right? Like, even putting aside what we're building here at Ivy Invest and the fact that I'm not technical, but you and our third co-founder, Arash, certainly are, and Arash in particular is making enormous use of some of the new AI tooling in his workflow. We've seen it in our cohorts at StartX, for instance, right? So many of those founders that we talk to are building products that have been built with really lean teams, and I think it's something that we're seeing as we talk to a lot of other founders.
Yeah, and what's interesting here is, I think, as you think about going back to our topic of how do you pick individual companies to invest in, let's look at a segment of the market that has, I think, gotten really hot, which is late stage secondaries. And we've talked a fair bit about private market secondaries, the ability for people to go buy shares in these very late stage private tech companies, that are often valuations in billions and billions of dollars, with the hope, obviously, that in the time to liquidity, the time to IPO is shortened. I think those are some of the companies that may present the greatest risks here, because they were built in an era where there was none of this AI tooling, and so they often have really large software development teams, really large teams writing content from scratch. But they're not obviously well established to the point they're public companies that have war chests necessarily that they can leverage to kind of...
They haven't clearly won the day.
They haven't clearly
won their market.
Right, exactly. And so, the question is, will the executives at these companies, do they have it in them in some sense to really get lean? And it's just hard, right? Because there's a lot of institutional knowledge in these people. And I would never suggest people go eliminate jobs. But the truth is, it's just going to be very hard to compete against some of these new entrants who are able to rapidly get there with many fewer people. And ultimately, that's either going to translate, one, into, a race to the bottom in terms of pricing, because they'll be able to offer the equivalent product at a cheaper price. Or it's just going to result in these companies being massively more profitable because they're, the below the line expenses are so much less.
That's interesting. I actually, think about sometimes from the opposite perspective. We have seen a lot of excitement around some of these companies and a lot of initial excitement to adopt the tooling and the products that are coming out. And I think what isn't yet known is just how sticky that customer base will be, whether we're talking about consumers or enterprise, particularly enterprise, because I think the abundance of the startups that are coming out to tackle similar verticals and industries and launching competing products, both to compete against some of those later stage companies that you referred to, but also against each other. I can say from my conversations with, let's say, asset managers or some of their portfolio companies that are really eager to try these new products, in the same sentence, they'll often say, we're excited to try this product and all of their competitors. And with each one, we are making sure that we are not making it really difficult to rip out and replace in case something better comes along, because things are being built so quickly and the pace of change is so much more rapid than we're used to. And so, again, these are anecdotes. Anecdotes, anecdotes together do not equal data.
The plural of anecdote is not data. Yeah.
Yeah, exactly. And so yes, these are just anecdotes, and it may not ultimately end up being as much of it may end up being overblown, this concern about the ability to retain customers and the ability to retain that revenue base. But I think there's still a lot of unknowns there. And so I agree with you on the challenges to some of these later stage companies. But I think even the early stage companies that have seen a lot of rapid success, there's still a lot of questions, right?
Totally. And I think you see churn rates for a lot of these early stage companies are much higher than you historically would have seen for B2B companies in similar markets. And I think there's even more of an existential risk here in some ways. One of the topics that I see a lot of discussion around with fellow founders is actually this question of whether enterprises will even buy software in the future. In that the cost of building software and the speed of building software is coming down. And will it even make sense for an enterprise to go buy an off-the-shelf piece of software that may only meet 80 or 90% of their needs, and then you got a huge chunk of the product they don't even use and are paying for? Or will everybody just have custom software that is designed specifically for their use cases? And the truth is always going to be somewhere in between, because not every enterprise, not every business is going to go hire a legion of developers to go, or even a handful of developers to go build and maintain their own software. But I do think that the SaaS model of software that we've become so accustomed to, which is this idea that you build a piece of software, you run in the cloud, everybody more or less gets access to the same piece of software and is running the same thing. I think that model is going to shift in a world where you can custom build functionality so much more easily.
Yeah. Well, I mean, we've seen how some of those concerns are playing out in the public markets, and depending on who you talk to, the concerns may be very overblown. But I think that is certainly one of the more active debates happening right now.
Yeah, you bring up an interesting point about the public markets. I think even just we're filming this on February 12th, 2026, I think even just in the last week or so, I think we've seen some meaningful movement in certain sectors in the public markets out of concern around this, right?
That's exactly right. In the past week, we've seen product releases from companies across various industries, whether it's legal industries or accounting industries or asset management industries. And these tech companies have released new product features that the market has reacted pretty strongly to in each of these sectors, right? And so it's fascinating to sort of be in this mode where folks are really concerned about avoiding the folks who will be most negatively impacted. And I think there's a little bit of feeling of unease, as nobody quite knows where the dust is going to settle. And I think if you extrapolate that uncertainty that folks are experiencing even in the public markets, and going back to where we started, then trying to say, let me try and pick winners in the private markets, again, I think it's such a challenge, right? Especially now.
Yeah, and having sat in Silicon Valley now for 20 plus years, I think one lesson that I've certainly learned is it's so hard to predict. Even when you sense a new technology innovation or disruption coming, right? Whether it was mobile, whether it was SaaS, now AI, it's so hard to predict the second and third order effects of all that. And I think there have been companies that everybody assumed would get crushed and die and manage to turn it around, and there's others that everybody assumed were going to be the big winners and experience kind of extinction level events. And so I think the only thing we can safely say is that we know nothing at all here. But a great discussion on broadly the perils of or potential perils of picking individual investments in today's world. Thanks for joining us this week on the Investment Office. We'll see you next time.